Last part of the chapter 11 is about the debt crisis, financial crisis. So it's the risk for the international bank. Some of the largest banks in the world were endangered when loan was made to the government, sovereign government of some less developed countries. So this less developed country is usually called LDCs, less developed country. Usually the less developed country sometimes generate the problem, so-called international debt crisis. Sometimes this is also called a third world debt crisis because it's usually caused by this less developed country. It's basically the country do not pay back their debt. And that these actually are pretty serious. Why? Because it's sovereign nations. It's very hard to penalize this default. Historically, international debt crisis began on August 28, 1982. 1982. When Mexico asked more than 100 US and foreign banks to forgive its billion, not million, I'm sorry, $billion in loans. Soon after, Brazil, Argentina, and more than 20 other developing countries announced very similar problems. So at the height of the crisis, third world countries owe $1.2 trillion. Big, big, big money. For years, it appears as if the crisis might bring down some of the world's largest banks. So, for example, on average in 1989, the World Bank estimated that 19 LDCs had debt outstanding equivalent to 53.6% of their GNP. GNP is like GDP. The GNP is the gross national products. So they basically calculate the gross product for their nationals, their citizens actually. GDP is the resident, the GNP is the nationality. And GNP is actually widely used until 1990. So 1980s, usually we use GNP. Now we use the GDP instead of GNP. Interest payment alone amount to 22.3% of export income. So it's very seriously high debt, right? International bank are obviously the fearful, right? So this type of international debt crisis generate a serious problem to international bank. So this debt crisis should be resolved actually, right? So one way to resolve this, a secondary market developed for these LDC debts, so less developed countries that at a price is discounted significantly from face value. The secondary market consisted of approximately 50 creditor banks, investment banks, and boutique market makers. And this LDC debt was purchased for use in debt for equity swaps. Debt for equity swap. So as part of the debt rescheduling agreement among bank lending syndicates and the debtor nations, creditor bank would sell their loans for US dollars at a deep discount from face value because it's highly likely not paid, right? So they give the big discount and sell to the multinational companies which wants to make equity investment in subsidiaries or local firms in that country, in that less developed country. An LDC central bank would buy the bank debt from an MNC at a smaller discount than the MNC paid, but in local currencies, not the dollars. So they don't need to pay dollars. The MNC may use this local currency to make pre-approved the new investment in in that country that was socially, economically all beneficial to the countries and their nationals, the people there. Okay, so that's how debt for equity swaps work. They basically swap that for equity. The purpose of this agreement is, well, think about it. So if these LDCs just declare default and don't pay back any debt, then this bank would face big trouble because 1.3 trillion, 2 trillion, yeah, $2 trillion owed, and they don't pay. And even though they would not pay this debt, it's very hard to give the penalties because they're sovereign nations. Therefore, to avoid this problem, they set up kinds of some agreement with the country, and countries pay the portion of the debt as a form of this swap contract, right? And then they basically use the local currencies to pay this debt, like a repurchase, basically, right? And what they can do is they can let this company, multinational company, to use this money in the investment in their country, own country, so that they can use this money as a source of the investing in social capital, and they can let company hire what the local people, right? So it's kind of a win-win game. In textbook, there's exhibit 11.10. You can see the relation, like how it works. And you can get to know better if you are more interested in this part. Well, these days, most debtor nations and creditor bank would agree that the international debt crisis is effectively over. Okay. U.S. Treasury securities in Bush administration, not the second one, actually, the Bush father Bush, the first Bush administration is largely credited with the designing the strategy in the spring of 1989. So that's the Bush administration, first one, to resolve this problem. So his solution was to offer a creditor bank one of the three alternatives. The first one, convert their loans to marketable bonds with a face value to the 65% of the original loan amount. Number two option, convert the loan into the collateralized bonds with a reduced interest of the 6.5%. So first one, they basically just convert this to only 65% of the principal will be paid. Second one, they reduce the interest rate. Third, lend additional funds to allow the debtor nation to get on their feet. So the third option is just provide more funds. Okay, as we all can imagine, few banks chose the third alternative, so they mostly choose the first one, second one. The second alternative is called for the extending the debt maturities by 25 to 30 years and to the purchase by the debtor nation of zero coupon UST bonds with corresponding maturity to guarantee the bonds and make them marketable. And these bonds have come to be called Brady bonds. So these agreements basically is done to resolve this issue. So United States government actually intervened because many US bank has trouble, and they give the three choices to the bank, and bank usually choose the many cases just the number two, with the extending the maturities to a very long term. And the United States government actually is guarantee that. So that's the story in the international debt crisis. Asian crisis. Asian crisis is in I believe 1997, right? So, I mean, we already see this crisis before in chapter 2, and also we have, and the the class also assigned the Hong Kong crisis, the case study, right? So the crisis began when the mid 1997 in Thailand, actually, and a lot of other countries, other than Thailand also, their currency started to depreciate. So the crisis followed the period of economic expansion in the region financed by record private capital inflows. So many countries opened their financial market and they start to borrow money from international bank and many short-term loans actually. And bankers from these G10 countries, so it's G10 countries, the very well-developed country, right? Actively try to find to finance the growth opportunity in Asia, and they led a lot of money. However, there may also have the trouble because the risk is not like rightly measured. And this capital actually boosts up the price of the asset, especially the real estate. Housing price soared up, create the domestic price bubble in East Asia. And there are other like a moral hazard issue here, like that so relationship very important in Asia when they do their business, especially that time. And this creates actually the poor investment decision because there's some relation between the commercial firms and the financial institutions, and that they actually have a special relationship. And sometimes the investment making decision is poorly made. So the Asian crisis is only the latest example of the bank making a multiple of the poor loans spurred on by competition from other banks to make a loan in a hard region. So that's interesting, right? So it's very like the developing market. So we try to, like a bank want to finance it, want to provide the finance, the pump funds, and they compete. So they sometimes manage their risk in a wrong way, actually. The last crisis we're gonna see is a global financial crisis. It's very famous crisis, actually. Probably you all know, heard at least, and many people are directly affected by this crisis, including myself, actually. It officially began in the United States in December 2007. The origin of this credit crunch can be traced back to the low interest rate environment created by Fed in the early part of the century. The reason is, as you know, the United States stock market crashes around 2000. It's called the dot-com bubble. So NASDAQ was created and it developed very, very fastly. And everybody invests in the dot-com stocks, even though sometimes it's not related to IT industry. They just change the name to dot-com, and the stock market, like people just bought the stock like that. I mean that create bubble clearly, right? And the bubble burst, and the one of the resolution of boosting the market is the declining the interest rate. So lower interest rate a lot, like a deep low. It means that, I mean, people can get the easy money. Many bank and mortgage lenders lower their credit standards because they start to compete because the interest rate is quite low. So I mean many people can buy a house very easily, right? And this is another hard market like Asia, right? So to compete, like to give some attraction to the customer who want to make a loan, many banks and mortgage lenders lower their credit standards, and they think they should be fine because if the real asset price keep increasing, then their collateral value keep increasing, so they don't care about that. Really, that's probably the biggest mistake they make. Many of home buyers do not qualify, actually. Probably did not qualify as a prime loan. Sometimes just go to the subprime market. So because the borrowers could not meet the standards. So there's subprime market created, actually. Not held by the originating bank, actually, because these kinds of dangerous loans, so they immediately sell. And packaging into so-called the mortgage-backed securities, MBS. Between 2000 and 2006, the volume of these subprime mortgages increased substantially, right? As we all know, $600 billion. Still, I mean, if they pay back well and the collateral value, which is real risk value, keep increasing, this loan's fine and makes a lot of money because of high yield, high interest. But the thing is, if people don't pay back and the real asset pricing start to decline, then it may generate a problem. And creating MBS, the mortgage-backed securities, is kind of the good sense, you know, because conceptually this MBS makes sense. Each MBS represents a portfolio of the mortgages, right? So the diversifying the credit risk that the investor hold. So SIVs, the structured investment vehicles, was one large investor in MBS market. This SIV is a virtual bank operated by the commercial bank or investment bank, but they are not on the balance sheet of this operating bank. So they have separate entities. Typically, these SIV raise the short-term funds in commercial CP market, and finance long-term investment in MBS. So it means that you borrow money short-term and invest money long-term. There must be some spread between short-term and the long-term. And if you keep borrowing from the short-term market, it's fine. Again, if not, then there's a problem. These SIVs are highly levered because they basically just borrow money from CP market, right? And the ratio is 10 to 15 times of the equity. I mean, as I said, there should be spread if yield curve is upward sloping, right? So that's basically what they want to make. But if underlying mortgage borrower default on their home loans, then the MBS value is gone, right? And SIV will lose the investment value too. So they actually have to think about consider the default risk. Another big investor is a CDL. It's called the collateralized debt obligations. It's a corporate entities to hold this portfolio of the fixed income assets such as collateral. So fixed income assets, usually the debt as a collateral, they hold these portfolios. So this portfolio of fixed income asset is divided into different, tranches, right? Each represent the different risk classes based on the credit rate. So like the AA, single B, things like that. Unrated is risky one actually. CDO, these collateralized debt obligations, served as an important funding source for fixed income securities because they invest a lot of money in fixed income market. And invest in a CDO is taking a position in the cash flow of the particular tranches, right? Not in the fixed income security directly. So, the CDO is another big investor. Now, generate the bubble, right? If the bubbles start to have, then Fed have reactions. They have to cool down. So the Fed steadily increased the Fed funds target rate. So it increased the interest rate, actually. So in 2003, so 1%. Now 2006, it raised to 5.25%. In turn, mortgage rates increased. Many subprime borrowers found it difficult because the mortgage rate decreasing, and many mortgage was not fixed, actually, it's adjustable. So it's a floating rate. So their payment increased a lot. That's probably typical reaction for the subprime market, because the subprime market is not it's the market with bunch of bad credits, right? People with bad credits. So when subprime debtors start to default on their mortgages, CFI investors now unwilling to finance these SIVs, right? It's the engender. Liquidity worldwide essentially dried up because the commercial paper market is very important to provide the liquidity. It's a short-term loan market. Now, the spread between the 3-month euro dollar rate and the 3-month UST bill, which is called the TAT rate spread. So it's a difference between the euro dollar rate and the T-bill rate. Its measure of the usual credit risk increase about 30 basis points, 30 BP, which is 0.3% point in March 2007, to 200 BP, so now 2% points in November 2007. So the credit risk start to increase because investors start to have fear. Even in the international, like a strong international bank. Many CDOs and found themselves stuck with the highest risk tranches of MBS because they basically invest a lot of MBS, right? And there is a subprime mortgage MBS too, and startups problem. And commercial and investment banks have been forced to write down over 170 billion of subprime debt to date, with as much as $885 billion expected. So have a trouble, right? So default starts. What is the lessons? Now, these all crisis lessons actually gives us certain lessons now. The credit rate agencies need to refine their models for evaluating theoretic credit risk created in MBS and CDLs. Okay. Borrowers more wary of putting complete faith in credit rating, and bankers seems to scrutinize credit risk less closely when they serve only as mortgage originators rather than the paper holder themselves. So they basically have to evaluate rightly. Borrowers should have to suspect. Okay. Banker needs to look more closely. It means that when this risk hit on the market, many investors, many banks found that they were exposed actually to the risk that they never imagined. They thought that the risk level is like this much, but in fact, this much, actually. So that's the lesson from the global financial crisis, subprime mortgage crisis. Okay, so that's the end of the chapter 11. Chapter 11 has many stories about international bank and eventually about financial crisis. Reading this chapter may be a good idea, one good idea. I mean, I want you to know, like this is kind of knowledge, it's a chapter with a lot of information, right? But the last part, the crisis part actually is quite important because, I mean, competition creates the crisis. Many cases, like in LDC market, that crisis, the Asian crisis, even global financial crisis, like the Great Recession period, it's all from the fierce competition among the banks, among the financial institutions who try to provide the loans. The problem is when competition increased, sometimes they forgot to evaluate the possibility of default more closely or more accurately. They just ignore these parts and just compete to lend money so that they can make money. Eventually, they are exposed to the too high level of risk, and something happened, then everybody has trouble, right? So that's the end of this chapter. Thank you for watching chapter 11, and see you in the next chapter.